If I were to ask you to define what the stock market is, what would you say? Most people would probably say something to the effect of it's a place where people can buy and sell ownership of publicly traded companies, right? Now, let's take it a step further and ask what the price of a stock reflects. Again, the simple answer you'd likely get from most people is how much a company is worth based on factors like top line revenue, longevity, growth, bottom line profit, et cetera, et cetera. In its simplest terms, those are absolutely true answers. But when you start talking about stock market investing as a whole, and you look at the most popular barometers for the stock market, like the S&P 500, there's a pretty significant misconception that starts to form, and I see it all the time. One of the biggest misconceptions about the stock market is that it's essentially just a giant thermometer for the economy. Companies do their thing in the real world, the real economy, investors observe the results, and the stock price updates accordingly, giving you a sort of temperature reading for the economy. If the economy is doing well, companies will do well in it and the market will go up. If the economy is doing poorly, companies will suffer and the market goes down. And obviously, because we are in a consumer driven economy, the health of the companies also informs the health of the economy as a whole. So there's a little bit of a kind of chicken and the egg situation and dynamic to it. But overall, the idea is that the market reflects the economy. But that's really only half the story because companies aren't just putting out quarterly earnings and letting the chips fall where they may. There are a lot of interactions, channels, and interconnectedness within and between many of these publicly traded companies that significantly influence one another. Economists call this a feedback loop. And there are all sorts of feedback loops within economic systems and elsewhere for that matter. And today, I want to look at how some of those work within markets to affect stock prices. So, to help you understand how all of this works, I've got two examples for you from headlines I've seen this week. The first one was from CNBC about bank earnings, and the headline reads Big banks poised to report booming revenue propelled by SpaceX IPO, Iran war volatility. So here's the context. This week, five of the largest US banks reported their Q2 earnings. So that's JP Morgan, Goldman Sachs, Bank of America, Citigroup, and Wells Fargo. Those five banks account for roughly 3 to 4% of the S&P 500. And this article was published a day before earnings were published based on analyst expectations. And those expectations ended up being blown out of the water this past Tuesday. Several of the largest US banks recorded crazy record smashing earnings, and Goldman Sachs led the way with profits jumping 78% and revenue surging 39%. Now, in this article, there are three very important things to pay attention to. The first two are in the headline itself, the SpaceX IPO and the volatility from the Iran war. So let's talk about the IPO. To understand why IPOs are so valuable to Wall Street, you first have to understand how investment banks actually get paid. So, when a company decides to go public, it typically hires several investment banks to underwrite the offering. And underwriting the IPO basically means that the banks help determine the initial price, market the shares to institutional investors, gauge investor demand, and ultimately distribute the shares to buyers. So by the time an IPO actually hits the market for retail investors to buy in on the first day of trading, there's already been a ton of work on the back end, including distributing those shares to institutional investors to begin. And for all of that work, and it is a lot of work, the banks collect an underwriting fee, and it's often referred to as a gross spread. In the United States, that spread historically has been anywhere from 3 to 7% for a lot of traditional IPOs, but it can be a lot lower for very large offerings. For the SpaceX IPO, because the valuation was so insane, the gross spread ended up being just 0.7%, but that's still $500 million on a $75 billion allocation. Goldman Sachs and Morgan Stanley each got about $100 million of that. Bank of America, Citigroup, and JP Morgan each got about 75 million of that, and the rest went to smaller syndicate banks. So it's no surprise that a record-breaking IPO would lead to record-breaking investment banking profits. It's an incredibly lucrative business for the banking sector. But here's where it gets even more interesting, because the headline focused on the IPO and the rise in trading fees, which I don't really have time to go into a ton of detail on it, but for the sake of our conversation, basically, the continued war in Iran has led to higher volatility in the markets, as we've all seen, meaning, among other things, investors are trading more frequently. Higher trading volumes leads to more fees generated because more trades are happening. So while the news of the conflict itself has led to a lot of ups and downs in the market, depending on what happens and what politicians say, banks are reaping the profits of the higher trading volume themselves. But getting back to the IPO, there's a discussion buried within the article itself, because remember I said there were three very important things in the article. And the third one deals with a concept called soft dollars. These banks don't simply act as middlemen, helping to set up and manage an IPO and then collecting essentially a one-time fee. They also decide which institutional investors receive shares. And many times, there are more investors who want to invest than there are shares available, and we call that an oversubscribed IPO. And if demand is greater than the number of shares available, getting an allocation can be extraordinarily valuable for institutional investors. And that's exactly what happened with the SpaceX IPO. Depending on what source you looked at, the SpaceX IPO was anywhere from 2 to 4 times oversubscribed leading up to the first day of public trading. And that's just from the institutional investors who wanted a piece of the pie. Because if a stock rises significantly on its first day of trading, which is very common, those investors can earn potentially millions of dollars almost instantly. That means an IPO allocation is a scarce resource, and scarce resources have value. Now, banks generally can't sell IPO allocations outright. Any sort of like quid pro quo framework between a bank and a hedge fund that would say, do X amount of business with us and we'll give you access to this IPO would obviously create very serious legal and regulatory problems. But IPO allocations do become one of the most valuable relationship building tools that Wall Street has. And some of it is just the nature of business as opposed to anything inherently like shady or immoral. Let's say you work for an investment bank and you have two hedge fund clients. They're similar size, similar public notoriety. Overall, they have very similar footprints. But one hedge fund generates hundreds of millions of dollars in trading commissions, uses your bank as its prime broker, trades derivatives through your firm, and brings other profitable business in for you. While the other hedge fund only uses you as like a cursory broker, does maybe $1 million of trading commissions. Between those two funds, which one are you going to be more inclined to allocate IPO shares to? Hedge fund number one, simply because it's a much more valuable client to you and your bank. So, while the underwriting fee may be measured in hundreds of millions of dollars, the IPO itself often creates something just as valuable to investment banks: stronger, longer lasting relationships with institutional investors that generate things like trading commissions, financing revenue, advisory work, and other business for years to come. And that's why a lot of finance researchers, including a professor named Jay Ritter, who was quoted in this article, argue that the underwriting fee is only part of the economic story. The IPO isn't just a transaction, it's also an opportunity for banks to strengthen relationships that become recurring sources of revenue long after a single IPO takes place. In other words, the excitement surrounding a major IPO doesn't just affect investors, it influences where a hedge fund trades, which banks earn commissions, and how financial firms compete for institutional clients. So, even the existence of a public stock market changes behavior throughout the financial system itself, which also happens to be part of the very market. And here's why any of this matters and why I bring this one up in the first place. When most people were looking at the SpaceX IPO, the question and the conversation was simply around, should I invest in this? And there was a ton of excitement, FOMO, there was skepticism and optimism around it, but it was just focused on SpaceX itself, the structure of the company, the IPO as a mechanism for SpaceX to raise money. All true, all important. But it also created profits for investment banks and affected ongoing relationships. Those profits, as we've seen this week, increased these banks' earnings significantly, which can and did increase several of their stock prices. And higher bank stock prices make those firms even more valuable businesses, allowing them to hire more bankers, win more IPO mandates, see Anthropic, and generate even more fees from future deals. So, in other words, one stock going public doesn't just affect that company's business and that stock price. It can increase the value of the banks that brought it public, strengthening the very institutions that will bring the next company public. So, to make this more concrete, imagine a snowball rolling down a snowy hill. At first, what makes it move? Gravity. But as it rolls, it gets bigger. And because it's bigger, it rolls faster. The process starts feeding itself. Financial markets often work the very same way. A successful IPO creates profits for banks. Those profits make the banks more valuable. More valuable banks can win more business, which creates more opportunity to underwrite new IPOs, which creates more profits. So, are we seeing the snowball? The stock market isn't just reacting to events. So often, the activity of one company within the stock market changes and affects the decisions and behavior of other companies as well. So the market isn't just recording and displaying economic activity. It's helping produce and influence the next round of it, which leads me to my second example, because you can see the exact same feedback loop inside the inner workings of public companies themselves. And it's through a little idea called a stock buyback. Imagine you're the CEO of a public company and your stock has doubled in value over the last 5 years. That would be a pretty great position to be in, right? Your shares are worth more, your employee stock compensation is worth more, your company can theoretically borrow money more cheaply, but your job is to continue to provide value to your shareholders. You're not rewarded anymore for what has happened over the last 5 years because investors are very fickle. They want to know basically, what have you done for me lately? And there's one thing among many that investors reward: earnings per share. Earnings per share, or EPS, is exactly what it sounds like. You take the net income minus preferred dividends of a company and you divide it by the number of outstanding shares available in the market. As the CEO, what are your options for improving that EPS number? Well, the most obvious would be increasing overall net profit, increasing the top number of that equation. But that requires a lot of work and has to happen over time. Why not just reduce the number of outstanding shares? If a company quite literally buys back shares of its own stock, taking them off the table, as it were, you reduce the total number of outstanding shares, meaning you're dividing your current net income by a smaller number, immediately giving your stock a higher EPS value, even if the business itself hasn't grown at all. So, once again, the stock price isn't simply measuring the business's inherent success, it's reflecting more about economic incentives rather than economic health. So, how common are stock buybacks today? Well, I'm so glad you asked. The second headline I saw this week was from MarketWatch, and it reads: Corporate America is pumping $1 trillion into stock buybacks, but look at what insiders are doing. Yes, you heard and read that correctly. Total U.S. stock buyback announcements for the first half of this year were just shy of $1 trillion. And I'll link this article in the notes if you want to go do a deeper dive, because it goes into a lot more detail about some of the concerns around buybacks. But overall, to put this in perspective, 2025, last year, was a record-breaking year globally for share buybacks, with a total amount of, I've seen anywhere from 1.2 to 1.4 trillion, and we're set to match or maybe even slightly outpace that record-breaking year in 2026. So, in the midst of a 17-year and counting upward tear in the market, aside from like a blip of a recession that happened during COVID, we've got a bull market that is being affected by historic levels of stock buybacks that artificially boost EPS and, by extension, many times directly affect a company's stock price, which has nothing to do with their real world performance or overall health of the company itself. Now, I always want to present a fair view given any topic, and there are plenty of legitimate reasons that a company may decide to do stock buybacks other than simply financial engineering. The three most common ones typically are sometimes with employee stock compensation. The company may need to pull some shares off the market to make sure employee stock doesn't get diluted. Totally fair, totally valid. If you've got an activist investor trying to initiate a hostile takeover, repurchasing some of your own stock can be used to prevent that from happening. And there are some times where companies legitimately feel like their stock is trading below its actual value. So they're trying, with buybacks, they're trying to signal to investors that leadership truly does believe in its own company. But regardless of the reason, it's still an example of these feedback loops that exist within markets that have much less to do with the fundamentals that we say drive the price of a stock and more to do with how the market ends up incentivizing investors and influencing itself. But the reality is, this isn't actually about IPOs or banks or stock buybacks inherently. It's a story about something I've already mentioned a few times: incentives. Every day, trillions of dollars move through financial markets. Those dollars are constantly giving feedback and basically voting, as it were, on the ideas that people think are best. Which companies deserve more capital? Which industries deserve more workers? Which technologies deserve the money and the attention and the resources to build them? And once enough money starts flowing in one direction, people begin changing their behavior to follow the money. AI, which I talked about a few weeks ago, is the perfect example of this right now. Many investors, not all, but many, have become convinced that artificial intelligence is the one and pretty much only future of the world. So AI stocks, some companies people hadn't even heard of a few years ago, are skyrocketing to become the most valuable companies on the planet. And at first glance, it looks like the market is simply reflecting optimism and pricing in what they see from AI's current and promised future capabilities. But that doesn't just make NVIDIA's stock go up. Venture capital firms start funding more AI startups. Banks start becoming more willing to finance AI companies. Universities start creating AI specific degree programs. Careers that used to seem, even a few years ago, totally foolproof, like software engineering, start to look obsolete. Suppliers build factories to manufacture AI chips. The race to build more data centers heats up. And as time goes on, the economy contains more AI companies and far more resources and capital investments is put into AI than ever before. The higher stock prices didn't just predict the future, they helped create it. And we can tell the exact same story in reverse. It's not just AI. When Wall Street rewards companies that aggressively cut costs, which they often do, CEOs respond. Layoffs become more easier to justify. Automation accelerates. Departments shrink. Hiring can slow. And again, stock prices aren't just measuring reality, they're influencing the very decisions that shape reality. So, why in the world does that matter for you? Most of us are not Fortune 500 CEOs. We're not deciding whether to take our company to an IPO or whether a stock buyback makes sense. But we all live in an economy shaped by those decisions. The market influences where businesses invest, which industries grow, which skills become more valuable, which jobs get created, which technologies receive funding. So even if you've never bought a single share of stock, those incentives eventually work their way into your everyday life. So, for everyday investors, my point is that this massive thing we call the stock market isn't simply a collection of siloed companies that exist in a vacuum. They interact, they influence each other, they make decisions to incentivize investors, and even across different sectors to a significant extent, their success has a measure of codependency to it. The market, this collection of companies, is influencing the decisions that shape its own future. So the question isn't whether these feedback loops exist. They absolutely do. The real question now is what to do with this information and understanding of where it's happening. And for me, honestly, the biggest thing it does is make me a more patient investor. Because if markets influence themselves, especially in the short term, then short term price movements are often telling you as much about incentives as they are about intrinsic value. So a stock might be rising because a business is genuinely becoming more valuable, or because executives are buying shares back, or because a passive funds mandate hit a break point that triggered more buying, or because institutions are chasing momentum, or because banks are creating more financing around an entire industry, or fill in the blank. Because all of those elements are at play. I spend a lot less time asking, what did XYZ stock or sector do today? And a lot more time digging into why. Because sometimes the changing price is legitimately reflecting value, and sometimes it's helping create it. Markets don't just allocate capital, They allocate incentives, and incentives change behavior. Behavior change businesses. Businesses change the economy. And eventually, those changes show up right back where we started in the stock market. And at the end of the day, markets are made up of companies that are run by people. And investors, whether institutional or retail, are also just people. And as every single one of us can attest, people are unpredictable, we're many times irrational, and we all respond to incentives. Which brings me to where I always end these videos, which is what I call the biblical frame. We're moving from the macroeconomic discussion into a discussion of how I, as a believer, and a follower of Jesus interact with these concepts, both theologically and practically. So, this next part is for those of us who love and follow Jesus. And if that's not you, I'd love for you to stick around if you're at all curious. But if not, I hope you've enjoyed what I've talked about so far, and I hope you join me again. But the more I study economics, the more obvious I think it becomes that the market might influence people's behavior, but it doesn't influence our nature. It's simply a conduit to reveal human nature for what it already is. Markets amplify whatever people already collectively value. So if society rewards innovation, we get more innovation. If society rewards speculation, we get more speculation. If society rewards short-term thinking, we get more short-term thinking. The market is incredibly powerful, but it's still downstream of the human heart because it's not some amorphous blob making its own decisions. It's not a being. It's essentially just a collection of people, whether it's the investors buying into it or the people running the companies. We're collectively the ones that ultimately decide what happens. So the reason these feedback loops even exist at a systemic level is because they first exist in the human heart. For the last couple of months, I've been doing a Bible study on Deuteronomy, which has been absolutely phenomenal. And one of the things that keeps coming up over and over is this idea of what Israel would refer to as the Shema. It's the Hebrew word for hear that begins the most important prayer in Judaism. And it's from Deuteronomy 6:4. It says, "Hear, O Israel, the Lord our God, the Lord is one. You shall love the Lord your God with all your heart, with all your soul, and with all your might. And these words that I command you today shall be on your heart." Everything else within God's commands and everything within the law for God's people flows from that command. Whether it was their dietary restrictions, the clothes they wore, how they related to one another in business, how disputes were settled, how the most vulnerable in society were expected to be treated with dignity and respect, all of it flowed from an understanding of God and a unilateral love for Him. So, this command, this Shema prayer, is the answer Jesus gives in Mark 12 when the scribes ask him which command is the most important, making it clear that it is still deeply applicable in the Christian life today. We are to hear, meaning we are to understand, to remember, to constantly keep at the forefront of our minds not only who God is, but our response to hearing and understanding Him, our response is to love Him with all of our hearts, all of our mind, all of our soul, and all of our strength. And so many of the warnings within the law and scripture as a whole deal with the temptation of our hearts to disobey that command, to have things in our life that compete with our love for God, to prioritize false gods above the one true God. Why? Because whatever it is we focus on, whatever choices we make, incentives we latch onto, whatever has our attention has our heart. And whatever or whoever has our heart is what or who we will continue to focus on. It's a feedback loop. Where your treasure is, there your heart will be also. That's what Jesus tells us during the Sermon on the Mount. And notice, He makes it clear that the heart follows the treasure, not the other way around. Whatever it is you seek and treasure and value is what your heart will go after. Do you seek and treasure God above all? Does He have your heart? Or do you treasure comfort or power or approval or control? The stock market holds up a mirror to our human nature and shows us what it is we worship and how it is that our worship plays out in the day-to-day of our lives and our man-made system. And in this current cultural moment, I would argue that it's incredibly clear that we are, and by we I mean just people as a whole, we are currently running after the same desire that led to Adam and Eve's very rebellion in the garden. Genesis 3:6 tells us that Eve saw that the fruit was, quote, desirable for gaining knowledge. And what is humanity currently racing to build at this very moment and putting ridiculous optimism and obscene amounts of money towards? AI expansion. We are actively working towards and investing in a version of AI with superhuman intelligence that no human being could possibly fathom. Knowledge beyond the finite limits our created minds have. There is nothing new under the sun. So, yes, markets matter, as do prices and incentives and investing choices. But they are all ultimately downstream of people, and people, every single one of us, are ultimately driven by what we worship, what we treasure. That's why, as Christians, we shouldn't just pay attention to where capital is flowing. We should pay attention to where our heart's affections are flowing. What feedback loops of worship exist in your own heart that are influencing and determining what it is you spend your time and your money and your effort on? We should actively be asking ourselves whether what we're paying for and what we're valuing with our money and our time is worth anything at all. Whether it's accumulating more stuff, the bigger house, the nicer car, the best clothes, or spending more time on our phones, doom scrolling social media, or constantly consuming news. Are we spending more time doing that than with the God of the universe who we claim is the Lord of our lives, who happens to be suspiciously absent from our time and our focus? Because markets may shape economies, but worship shapes civilizations. And whatever it is you focus on the most, both with your money and with your time and your energy and your mind, that's where your worship is going to ultimately flow. And that is the feedback loop that you are feeding. Are you feeding a loop that helps you fall more in love with Jesus? Or are you feeding a loop that distracts you and competes for what should be your unilateral love of the God of the universe who loved you first? I hope you enjoyed today, and I will see you next week.